Welcome to another Straight Up Tuesday tip. I am 𝗬𝘃𝗲𝗵𝗁 with 𝗦𝘃𝗲𝗃𝗵𝗵 Financial, here with the boys,
The
Mark
boys.
and Tom.
Friend of the pod?
Friend of the pod.
Friend of the pod.
I think I'm family at this point, boys. I think I've gone beyond friend.
He's getting a little too relaxed with the mic. We're recording our second one today. He's coming in nice to the mic, making jokes. So, all right. So, for our listeners who don't know, 𝗬𝘃𝗃𝗵𝗁 with 𝗦𝘃𝗲𝗃 Financial back with us. We're here to talk about interest rates. Everyone wants to know, what are they doing, where are they going? We're recording this on March 18th, 19th,
19th.
St. Joseph's Day. What's going on with interest rates? What are you seeing at 𝗦𝘃𝗀? You have emails every week about the capital markets. Can you just give us a little bit of a baseline, and then we'll all put on our predictive hats here and say, hey, we think interest rates are going to do what?
So what are we seeing, or what do I think that they're going to do?
What are you seeing? What do you when you're at 𝗦𝘃𝗀? What are you guys seeing from your capital market guys? What are they relaying to you? What are they forecasting?
Steady as she goes. Stay the course. We get an email every week from our capital markets desk, kind of reviewing the, things that have happened in the news, any things that have come out from the Fed, what to expect in relation to, do we think things will spike? Will they come down? Will they hold steady, et cetera? And, when you look back over the last almost year, things are pretty flat. There's been a lot of, oh my gosh, things ran up 30 basis points over the course of the last couple of days, or oh my gosh, they dropped another 30 basis points. But in general, it's stayed in a relatively flat band. And I think, in fact, I hope that things stay that way for quite a while.
All right. So as a lender, you're not hoping for rates to drop?
Personally, no. I will just caveat this with, I'm the furthest thing from an economist. I don't even think I had to take an econ class to graduate with a finance degree. So, and if I had any idea which way interest rates were moving, I tell my clients this all the time. If I had any idea, I would make one massive bet, and then you would never hear from me again. Because if you were able to forecast the things that have been happening over the last couple of years, to any degree of certainty whatsoever, you would be wildly wealthy and not in this studio. So it's when I think about the economy in general, and when I think about the, call it the blunt force instrument that the Fed has, which is, the rising and the lowering of rates and whatnot, it doesn't seem to me that there's anything happening that would necessitate a rate drop. Inflation is still, whether you say it's holding steady, whether you say it's going up, whether you say it's significantly higher than what's being reported because there's certain things that are held out of the calculations, it doesn't really matter. It hasn't dropped to 2. It hasn't dropped below 2. And, home prices are holding steady. The stock market seems to be doing okay. The joblessness reports seem to be doing okay. So for the Fed to start cutting rates and for things to start dropping dramatically, I think the tide's going to have to turn against all of those things that seem to be going okay right now.
It seems like such a crazy topic. It's like, say, for an investor, 5.5% or 7.5%. It's no different than looking at a property that's got $4,000 taxes or $6,000 taxes. You calculate your number and you run it, and actually the interest rate is actually fixed. It's actually even more, like, it's even better than like the taxes that you're just guessing based on where they're at today and putting money on. Like, it's amazing how much conversation we have around interest rates when it's really just another variable.
Couldn't agree more. I make the comparison a lot to at the beginning of COVID, when you saw just insane spikes in lumber and different, other material costs that from a supply chain perspective just kind of went out of whack. Professional investors just have to make it work. It's an input into the equation that, sure, it's higher than you want it to be, but it means you have to either find efficiencies in other places, you have to buy better, you have to get through the renovation quicker, you have to be better on top of your taxes and in your insurance and the other variable expenses that you have. You just have to be better. It kind of forces you to be better. But I think where I come at it from is, I have conversations every day with investors who are either thinking of waiting or who are waiting for rates to come down. And in the case where there's a material change in interest rates, I think that what will have to happen with that is a material difference in the value of the property as well. That just seems to be what should happen if rates are going to change materially.
Those people that are waiting for rates to change are the same people that are waiting for the market to crash back in 2018, and they missed so much opportunity.
Well, what's the line? There's the meme going around, like, if you waited for rates to drop in whatever, like 1980, you would have waited 20 something. Like, there's some crazy stat about that.
Yeah, I think it was. I think it was in the late 70s, and rates had hit 7.5%. And if from that point forward you waited until rates dropped to buy a property, you would have waited for 22 years.
Yeah, like, it is what it is.
And the average price in the United States of a home had gone up 4x at that point.
Well, what's surprising, so we had 𝗦𝘃𝗲𝗵𝗵 and Mike Scanlon on a couple months back, and this wasn't just realtors throwing out like, oh yeah, they're going to drop. Like, he had hard facts of this is an anomaly, how high we've been based off the trend, whatever we were tied to. It's like, it's never been this high of a spread. It's got to give a little bit, but we're not seeing that, right? Like, we're in this abnormal period because we printed so much money where we might stay here for a while, right? I'm kind of on the same, I'm sold on the boat that things are going to be steady here, and we're going to see little variance, little dips and whatever here and there. But I don't know, I think I flipped my thinking to, all right, cool, underwriting stuff at 7%, here we are.
Totally. And one of the things that I think this time does is it rewards the professional investor who's really, really good. Inventory is hard to find. Labor is expensive. Money is more expensive than at least it was over the last 10 years or so. And for the professional investor out there, it is separating, like, the cream is rising to the top a little bit. Maybe not even a little bit, a lot. Like, there is no low-hanging fruit from an inventory standpoint. There's no easy money, whether it be in the private market or whether it be from someone like us or certainly from a bank. I mean, there's nothing easy coming from banks these days. So when there's not low-hanging fruit and there's not easy money, you tend to take the amateurs and the kind of the pretenders out of the market. And the pros are the ones who are in the market these days and the ones who are getting rewarded with opportunities. That is one part that I do actually like seeing. I'm seeing the most experienced, most liquid, most on top of their business guys doing more volume now than they were doing 2 years ago.
Yeah, and it's going to stay like this, right? Like, I don't know. My thoughts are we're going to be, in the spring next year, we're going to be talking similar to this. Like, nothing drastic happening either way.
I don't want to get into politics, but this conversation comes up all the time. How is where we're at right now going to change based on it being an election year? Opinion based. Does it matter? Is it just all relevant? That's just kind of a fake marker.
He's only an economist. He's not a political.
Well, it's more of a thought for either one of you guys that want to.
Yeah, I think we're going to have to cut the camera if we're going to start talking politics.
No, I'm not saying who you chose or who you like or who you don't want to vote for, but they usually say they go down.
Yes, that tends to happen. I don't think that this election is. What was the line? What was the famous Carville line? It's the economy, stupid, right? I don't think that's what this election's about. I think this election's about a lot of other things. And, sure, if the rates get cut and the market takes off and values don't drop, and, like, if they only get cut for cutting's sake, maybe it helps the incumbent. Maybe. I don't know. But Powell has seemed to have his own mind and and be pretty resolute in his own beliefs and thinking and path for what's right. And so I don't know that he'll be that influenced by it. I think that when it comes to, energy and food and housing, inflation is not at 3%. I think those costs are significantly higher. And if you lower rates just to arbitrarily lower rates, I think that only heats things up again. I think inflation continues to rise, and on those core expenses that the average everyday family is, still struggling with, I think it only goes. I think it only makes it worse. Again, it's only an opinion. maybe backed up by some fact or some logic. But it's my hope that rates don't drop just for dropping's sake. And it's also my hope that, the market doesn't take a tumble, that joblessness doesn't spike, and that, housing prices don't crater. That would generally be the reasons why the Fed would then take the drastic action of starting to cut rates. Like if everything's holding steady and people are working and housing prices are firm, seems like they're kind of where they should be.
How does interest rate staying still or going up slowly over the next couple of years change the capital markets, the places that companies like Renovo or these other middle tier places get their money from? Does that change at all? Is that good, or does that squeeze out competition? How does that affect things?
I think it squeezes out some of our competition. Generally speaking, when you have capital that gets more expensive, capital just gets more discernible, right? When capital's cheap and easy, it kind of gets spread around, and let's see which spot wins, right? Let's see which stock takes off. When it gets expensive, it just gets more discernible, and you have to place it in places that are a little bit safer. We're the only company of our size in the country that maintains its own servicing book. We just finished up getting rated by Standard & Poor's and Moody's. Our delinquency rate is about a third of the industry standard. Our credit guidelines are tougher and stronger. Yeah.
I'm kidding.
Right, yeah. We're going to have to talk. Our credit guidelines are tougher and stronger than most. And we take a super localized, actual, relationship-based lending approach that keeps us a lot closer to borrowers. The whole know your customer thing is becoming a big acronym and a big thing amongst the lending world. We can thank Wells Fargo for that. And so it's worked out well for us. It's kind of one of those things over the last handful of years. The harder things have got, the better it's gone for us. And that was many, many years of grinding through setting a very, very deep and very firm foundation of which to build off of when things were hard. Other lenders that are out there that take just a different approach. When capital's free and easy, they tend to get their share of it, and when capital is hard, it kind of flows away from those spaces. So it's been good for us.
Awesome.
All right, ready for Chicago Fact?
Yes.
Sponsored by Renovo. Who are we playing for?
Sponsored by Renovo. We're playing for 𝗬𝘵𝗶𝗵𝗁, who purchased a pair of Straight Up Chicago Investor sweatpants on the merch store, straightupchicagoinvestor.com.
Connie sounds like someone who celebrated the parade as well this weekend.
Yep.
All right, so I'm wearing my Cubs hoodie over here. I know Eric across the table is a huge Cardinals fan.
Huge.
All right, so the Cubs and Cardinals have played almost 2,500 times. Okay. How many games have the Cubs won? And your options are, so 2,500.
Yeah.
Have the Cubs won 1,521, 1,403, 1,267, or 1,120? So 521, 1403, 1267,
I'll say
1120, 1250 would be
1267. I would have said.
You think it's equal?
Yeah, I
I
think.
think it's about even.
Yeah. Well, I'd say that based off the Bears and Packers, like they're pretty even over the time, even though it might not feel that way in our generation.
No, the Packers own the Bears. Actually, I think technically Aaron Rodgers owns the Bears. He's still listed as the landlord on Wikipedia. But I do think he transferred title to Jordan Love, though, who is our next generational Hall of Famer. I don't think that it's 1,500. I don't think it's like a 2/3. That seems 1,500, 1,400, 1,200, or
1120.
All right. Well, as the Cardinal faithful, I'll go with 1120.
You think I would put? That's why I didn't do the Bears Packers stat. So 1267 is the answer.
All right. Connie, you get a $50 gift card brought to you by the Workman team, Renovo Financial. So, all right, we got one right. I'm telling you, I'm happy we got the second one right because my day's ruined usually when we don't get it right. But all right, Eric, man, thank you for coming back again. Tom,
of course.
Thank you. Listeners, straightupchicagoinvestor.com. Check out the resource page. We just added some new resources. It's still around tax time. If you're doing, there's a tax checklist on there. There's a multifamily purchase thing. And what I think we should maybe get on there is like a DSCR loan calculator. Yeah, like that'd be something cool, or at least a form that people could download. Brandon by the Workman team. But thank you for coming on. Tom, thank you. Listeners, we'll see you Thursday.
Thanks all.
Thanks, guys.